Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, everyone. Welcome to another episode of On My Way to Wealth. My name is Luis Rosa, and I am your host. Today, I want to talk to you about married filing jointly versus married filing separate. I get this question a lot by my clients, so I figured let me do an episode about it because I'm sure a lot of you might have the same question. So let's start off by saying when you're married, you're supposed to file as you were as of December 31st of that tax year. So for example, let's say you are single, you might have lived with someone, and then you decide to get married December 30th. Well, in the IRS's eyes, you are now considered married, even though you were not married for most of the year. So keep that in mind. That's number one. So as you were December 31st, when you're married, you have two choices. As far as taxes, you either file a married filing joint tax return or you file a married filing separate return. So you cannot be married and file a single return because that would be against the IRS's rules. So it's either married filing joint, married filing separate. Now, that being said, when you have to file married filing separate, it typically isn't the best scenario from a tax perspective, generally. There are some exceptions, which I'm going to go over in this episode. But for the most part, when you compare apples to apples, married filing jointly, it's typically better than married filing separate when you look at the overall benefit to the household. So wanted to tell you about a little exception when you are married legally, where one person can file as head of household, which is an even better tax bracket to be in than single. And that is an exception that is made for people who are legally married, but they file a separate return from their spouse. They pay more than half of the expenses of that house and provide a primary residence for a qualified dependent and have not lived with their spouse for the last 6 months of the year. So there are situations where somebody is probably still legally married, but considering getting the divorce or already started the process. And let's say that happens to be like in February, March of the year, the spouse moves out, one of you stays in the home, you provide more than half of the support for you and your qualifying dependent, and you don't live with your spouse, you're filing a separate return, you can then go ahead and file head of household, even though you are still legally married. That's one of the exceptions. Now, aside from that, it's either married filing separate or married filing jointly. Now, why would somebody file a married filing separate return? Several scenarios. For example, I have clients that are paying back student loans and they're on an income-based repayment plan, which every year when they have to certify, it asks for proof of income, usually tax returns and all that. So a lot of people file a married filing separate return in order to then qualify for lower payment under student loan. Now, when we compare the returns from a tax perspective, the married filing joint scenario would have been better. But the savings from the student loan repayment under that one income is bigger than the savings. So that is something that you definitely want to look at before you go that route. Are you saving more in the student loan payments than you are in the tax difference that you have between married filing joint and married filing separate? So something you definitely want to speak to your financial planner about and your accountant before you make that move. So that's one reason. Another reason, sometimes there's one of the spouses that has a very large medical expenses. Typically, in order to itemize your medical expenses, they have to exceed 7.5% of someone's adjusted gross income in order to then use that amount as an itemized deduction. So there are situations where one of the spouses maybe didn't have that much income, but had a lot of expenses that year for medical or dental, and maybe the joint income does not allow them to itemize. So then one strategy will be for that person to file a married filing separate return and get to deduct those medical expenses. Now, something to keep in mind, when you file married filing separate return, the IRS requires that both spouses either itemize or take the standard deduction. So you cannot have a scenario where one spouse is itemizing and then the other spouse is taking the standard deduction. So something to keep in mind as well, because that definitely takes away from the benefits sometimes. If you're thinking like, oh, well, I can itemize and you can take the standard, it doesn't work that way. So from the IRS standpoint, if one of you itemizes, the other one has to itemize. If one of you takes a standard, the other one has to take the standard. So that's something to consider. Another scenario where I've seen spouses filing and married filing separate return is when one of the spouses has debt. Maybe you just got recently married, your spouse owes student loans that are in default, and every year their refund gets taken because it gets rerouted to pay that student loan debt. The new spouse says, hey, you know what? I have nothing to do with that. I want to keep my refund. So I'm just going to go ahead and file a married filing separate return. There are things that you can do. It's a little bit more complicated and it depends on the situation, but there's a injured spouse form that could be filed with the return, but it's cumbersome. We're basically telling the IRS, hey, this is nothing to do with me. This is my spouse's. It kind of separates it. And then it gets calculated where it's like, all right, this is your portion of the refund. And, the portion that belonged to the spouse that owes the debt gets confiscated, if you want to call it that, rerouted towards the student loans or whatever it was. And then the other portion goes to the spouse. But sometimes it's just a lot cleaner to do married filing separate. But there are lots of things to consider, which I'm going to go into it a little bit. Another thing I've seen is when people are already contemplating getting divorced or they just want to have separate finances from their spouses. Just from that pure standpoint, they just go ahead and do married filing separate. But let me tell you about some of the things that you lose when you do married filing separate. So you have to see what the benefit is and if it outweighs what you're giving up. One thing you lose when you do married filing separate returns, you cannot do the earned income credit. You cannot get the dependent care credit. So even if you have children, you pay for their care, whether it was after school or whatever it was, you cannot take that deduction. Tuition credits, those also go away. So you get penalized pretty significantly when you do married filing separate. So you have to really, really take a look at the benefits of doing so, unless it's just a situation where, it doesn't even matter in terms of money. It's like you just have to do it because you're already planning a divorce or something like that. But that's something that you really want to consider. And I highly recommend that you speak to a financial planner or certified public accountant or IRS enrolled agent before you decide to go that route. You also lose the adoption credit, unless you lived apart from July to December, basically kind of like the same rule as the head of household. That gets lost. Some education credits, like the lifetime learning credit, you lose that as well. The ability to deduct the student loan interest, I think I might have mentioned that one. Pretty big, right? A lot of us have student loan interest. If you do married filing separate return, you can kiss goodbye to that. Also, which is another one that doesn't get mentioned often, is the ability to contribute to an IRA for your retirement gets significantly reduced. Typically, if you live together and you're doing a married filing separate return, if you made more than $10,000, you could no longer contribute to an IRA, whether it's a Roth or a traditional. So that is something that is huge, because if you're doing some tax planning, financial planning, and you're putting money away for retirement and you were contributing to an IRA, well, you can no longer do that year that you decide to do married filing separate. So these are a lot of benefits that you could potentially be giving up going that route. So there aren't many scenarios where the married filing separate is better. But this year, 2020 tax year, 2021 calendar year, right? So this tax season for 2020 has changed that significantly because the American Rescue Plan. Right now, one of the things, for example, is that if you were on unemployment, you do not have to pay taxes on the federal side up to $10,200. If you're a couple, is $10,200 each if you were both on unemployment, right? So $20,400. But it phases out after $150,000 of adjusted gross income. So this is something I've been doing with my clients. Sometimes you have a couple that makes just slightly above 150 combined. And that is something that you want to consider, because now if you do marry, file, and separate, the spouse that made under 75,000, let's say, because usually that's the halfway point, where 150, can then go ahead and do the marry, file, and separate return. And in fact, $150,000 is still the cutoff for the 10,200 unemployment, even if you do marry, file, and separate. So you actually can do marry, file, and separate as one of those reasons if combined you make more than 150, but one of you makes less than 150, right? So that's one. So now you want to look at, okay, is it better for me to do marry, file, and separate, not pay income taxes on 10,200 of the unemployment versus doing marry, file, and joint and giving up the exemption on that 10,200? That's one major thing. That might be the deciding point right there. So if you have not filed your taxes, you were on unemployment and you're married and you are over 150 as married, but the person that got the unemployment is under the 150 as married, you want to look at that scenario and compare before you hit that submit button. Another thing that came with this third stimulus package is the actual direct payment of the $1,400. Same thing with the phase out. Married couples, the phase out is a hard 160. It starts at 150, it ends at 160. So now that's another thing to consider, where, you have a spouse that makes under 75 by themselves, and then the other one doesn't. But then you want to say, combined, we don't qualify for the third stimulus, but married, file, and separate, one of us does qualify for the stimulus. In fact, I just finished doing a tax return for one of my clients where that was the case, where it was both. The spouse that was on unemployment was able to not pay taxes on 10,200 of that unemployment. And now she actually ended up qualifying for stimulus 1, stimulus 2. So that's 1,200, 600, and stimulus 3, 1,400. That combined, they would not have been able to take the deduction because of their combined income. So when I did the return, marry, file, and separate, in their case, having to the ability to waive 10,200 for that one spouse of unemployment, plus qualifying for 1,200 stimulus 1, 600 stimulus 2, 1,400 stimulus 3, was a huge difference. They saved over $5,000 overall as a family by doing marry, file, and separate versus marry, file, and joint. So this particular tax year, 2020, made it just threw like a crazy wrench in the mix, where now you have to do those determinations, where before it was kind of like a no-brainer, marry, file, and joint was the way to go. Now you have to do a little bit more work to see what works for you, And this is completely legal. This is all there, the tax code. You can choose to do marry, file, and joint or separate, whatever works best for you. So you wouldn't be doing anything inappropriate by doing so. It's just part of tax planning, which is why it's so important to work with a professional that doesn't only look at your tax situation today, but also looks at the impact of things tomorrow. So you want to be not backward looking, you want to be forward looking. So you make sure that you work with a financial planner or a CPA that takes into account those kinds of things. So just to recap, for the most part, marry, filing separate is usually not the best scenario, with some exceptions. There are some legitimate reasons why you should look at it. But for the most part, in general, marry, file, and joint is typically the best option from a tax standpoint. This particular year, that has changed significantly if you're at that borderline with the phase out for the new stimulus and also the exemption of the 10,200 of unemployment. So I try to keep this very high level. Obviously, this is something that should be looked at on an individual level in your situation with your CPA or financial planner. But I wanted to kind of just give you a general idea of the things that you should at least be contemplating and on the lookout for before you decide to go one way or the other. So thank you all for tuning in. I appreciate you. I'll see you in the next episode. If you have any questions, send me an email at luis@onmywaytowealth.com, and see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.